Welcome to the deep dive. Today we're cracking open a classic, Coca-Cola, ticker symbol KO, as an investment. We've got some sources here that really examine whether this, global beverage powerhouse truly remains the evergreen investment anchor so many folks believe it to be. So our mission today is pretty simple. We're going to unpack Coca-Cola's core strengths, its strategies for growth, and just as critically, its potential weaknesses. Really want to give you a clearer picture of where it stands, as a long-term buy.
And that fresh perspective is absolutely vital because for a company as, iconic as Coca-Cola, it's incredibly easy to just rely on the name, the reputation, the past performance. But as savvy investors know, an impressive history doesn't guarantee future returns. Not at all. So stepping beyond those, let's say, surface-level assumptions is exactly why we need to take this deep dive today.
Okay, let's get into it then. When you first look at Coca-Cola as an investment, the history just jumps out at you. For patient investors, over the past 40 years, it delivered an amazing, 3,260% total return. And that's with reinvested dividends factored in. That's not just a big number. It really shows the power of compounding, doesn't it?
It really does. And the value of, sticking with it long term. Even a mature company can build serious wealth. And it's compelling how they manage that, especially when you think about how tastes have shifted away from traditional sodas. Coca-Cola didn't just, stick to its fizzy roots. They very strategically diversified the whole portfolio. They moved aggressively into everything, right? Bottled water, teas, fruit juices, sports drinks, energy drinks, coffee, even alcoholic beverages now. This huge expansion, basically, allowed them to offset those declining soda sales. They captured share across a whole spectrum of preferences. It sort of de-risks their revenue.
Yeah, that broad diversification is definitely a major play. But it's not just about adding new categories, is it? They've also been incredibly smart about refreshing their flagship sodas. Think about it, all the new flavors, the explosion of sugar-free options, even those smaller portion-controlled cans and bottles. It's a clever way to keep the core brand relevant, right? And keep attracting younger consumers who might be looking for healthier choices.
Exactly. And underpinning a lot of that success is what's often called their capital-light business model. Essentially, Coca-Cola doesn't own most of the physical bottling plants themselves. They sell the concentrates and syrups, and then their independent bottling partners handle the heavy lifting, production, distribution, sales of the finished drinks. This structure means lower capital spending for Coke itself, letting them generate these incredibly consistent high-margin profits. And critically, it largely insulates them from the direct hit of inflation or, say, regional macro challenges that the bottlers might face.
So that capital light model sounds incredibly robust. It insulates them from a lot of direct impacts. But does it also mean they give up some control or maybe profit margin by not owning the whole chain? Are there downsides to that hands-off approach?
That's a great question. And yes, they do give up some direct operational control. That's true.
Right.
But the trade-off is significantly higher margins and, importantly, reduced risk. They still keep strong brand control through, strict agreements and massive marketing initiatives. The resilience it provides, particularly in volatile global markets, usually outweighs those perceived downsides. It lets them focus on brand-building innovation.
Right. And you can absolutely see that resilience reflected in their historical numbers. It's quite something. From 1984 to 2024, Coca-Cola consistently grew revenue at a 5% compound annual growth rate, CAGR. And its split-adjusted earnings per share, EPS, that grew at a 6% CAGR. The remarkable part, they pulled this off through 5 globally recognized recessions. That's stability few companies can match.
And stepping back, this leads us to another really critical point for investors, Coca-Cola's status as a Dividend King. Now, this isn't just a fancy title. It means they've raised their dividend payout every single year for over 50 years. In Coke's case, it's an astonishing 63 consecutive years. That signals an unparalleled commitment to returning cash to shareholders. It's like a financial bedrock, weathered countless storms, provided consistent income. Their forward yield right now, what you'd expect over the next year based on the current price, is around 2.9%. Now, maybe that seems modest next to some bond yields today, but it gets increasingly attractive if interest rates start to decline, offering a really durable income stream.
Okay, so we've covered the impressive past, the really resilient model, but what about the road ahead? What are the key drivers analysts are actually betting on for Coca-Cola's next phase of growth? Looking out, say, from 2024 to 2027, the projections are interesting. Revenue growth is expected to stay pretty consistent, that 5% CAGR, but earnings per share, the EPS, that's expected to accelerate quite a bit, up to an 11% CAGR. So what's behind that?
Yeah, the drivers for that accelerated EPS growth are Well, quite varied, actually. You're seeing rapid expansion in high-growth emerging markets, like India and Latin America. They're introducing new local brands there tailored to those tastes. Then there's the robust sales from their wellness-oriented brands. Think Fairlife Milk, Simply Prebiotic Soda, alongside the continued strength of the sugar-free lines. Strategic acquisitions are definitely part of the mix, too, plus fresh variations on the classic brands. But a really significant driver, maybe less obvious, is operating efficiencies. And this is where AI comes into play. AI is impacting everything from product development and market analytics to pricing, more targeted marketing tools. It's about optimizing the whole value chain.
AI, that sounds like a powerful lever for efficiency, sure. But, I mean, how significant do you think AI's role really is in a company whose core product is still, soda? Is it truly a game changer, or is it maybe more of an incremental improvement? Maybe a bit overhyped.
That's a fair question to ask. And while AI might not, transform the taste of a Coke, its impact on the business of Coke is, well, it's profound. It's not really about making a better beverage per se, but about optimizing those supply chains, predicting consumer demand much more accurately, personalizing marketing at scale, even designing new products faster. For a company with Coca-Cola's global reach and sheer volume, even small, incremental efficiencies driven by AI could translate into hundreds of millions in savings or new revenue. So yes, I'd say it's a real game changer for their operational bottom line.
Okay. That technological integration, as you highlighted, is clearly a powerful lever then. And beyond that tech aspect, Coca-Cola is always fine-tuning its operations, aren't they? They're relentlessly optimizing the supply chain, continuing to refranchise bottlers, reinforcing that capital light model we talked about, and smartly pruning weaker brands from the portfolio. It seems like it's all about efficiency, making sure every dollar delivers maximum impact.
Exactly right. And when we look at where the stock is trading now, around $71 per share, it appears, reasonably valued at about 24 times its forward-adjusted earnings. This is why it's widely seen as a safe, stable stock, a reliable hold that tends to perform pretty consistently, whether it's a bull or a bear market.
Right. But of course, no investment story is complete without looking at the potential headwinds, the challenges. So let's shift gears a bit. Let's look at the weaknesses investors really shouldn't gloss over. One clear challenge is that growth is undeniably cooling off in established markets. Think the US and Europe. There's just much tougher competition now from a flood of newer drinks, often healthier ones, and those increasingly popular private label options.
And this brings us to a really key point. To offset that slowdown in developed markets, they have to ramp up investments quite significantly in those higher growth emerging markets. But that's far from a smooth ride. It introduces a whole new set of risks. Think about rampant inflation in some regions, volatile currency devaluation, the ever-present threat of political turmoil, and just the practical challenges of, undeveloped supply chains and logistics networks. Any of these could seriously disrupt their expansion plans and hit profitability.
So it's almost a catch-22 situation, isn't it? To get the growth, they have to step into riskier territories. And adding to that pressure, we can't ignore the broader macroeconomic concerns, things like ongoing trade wars, elevated tariffs, especially on aluminum for their cans. That could really squeeze their margins, couldn't it?
Oh, absolutely. The potential negative impact of those rising costs is significant. If bottlers are forced to raise prices because of tariffs or other cost pressures, and that happens to coincide with, say, a recession and weaker consumer spendings, well, you could easily see a double whammy. You'd get declines in shipment volumes and pressure on profit margins. That's a scenario that could directly hit that consistent profit growth we noted earlier.
Yeah, that makes sense. And when we talk about competition, it's always worth bringing up their arch rival, PepsiCo, PEP. On paper, PepsiCo trades at a lower valuation, right? Around 17 times forward earnings compared to Coke's 24, and it offers a higher forward dividend yield, about 4.3%. Plus, PepsiCo has its massive packaged food divisions, Frito-Lay and Quaker, which is a market Coca-Cola hasn't really entered, that offers a different, arguably more diversified revenue stream. So for some investors, PepsiCo might look, well, more compelling right now.
This raises a really important point. Despite all of Coca-Cola's undeniable strengths, a critical observation from our sources is its consistent underperformance against the broader S&P 500 index. Over the past 40 years, the S&P 500 delivered a total return of, 3,460%, compared to Coca-Cola's 3,260%. And this isn't just a one-off thing. This underperformance holds true over 30, 20, and even 10-year timeframes. It means essentially while you might have felt safe holding Coke, you likely left some significant returns on the table compared to just owning a diversified market index.
Right. And the likely reason for that underperformance is pretty straightforward, isn't it? Coca-Cola, being a classic defensive blue chip stock, it tends to lose some of its appeal during strong bull markets. That's when investors are rotating towards riskier, higher growth stocks. Meanwhile, the S&P 500 as a broad market index has historically averaged over 10% annually since 1957. It's almost that classic story, right? The steady, reliable tortoises often gets overshadowed by the flashy hares when the market's running hot. So, wrapping this up, what does all of this actually mean for you, the listener, as you look to build a really well-informed portfolio?
Well, I think the core takeaway from our source is pretty clear. Coca-Cola, with its, evergreen brands, its immense global scale, successful diversification, stable profits, and those consistently rising dividends, it remains a very reliable long-term investment. It's a fantastic, safe, income-generating anchor for a diversified portfolio.
Yeah.
That diversification part is key. However, it's crucial to understand it probably shouldn't be your only stock, not given its historical tendency to underperform broader market indices like the S&P 500 over the long haul. It's a foundational piece, you could say, not the entire structure.
Absolutely, a solid anchor. So if Coca-Cola's capital light model and consistent dividends offer that kind of safety, and its AI strategies hint at future efficiency, it prompts a fascinating question for all of us, I think. What other seemingly defensive investments out there might also be benefiting or could benefit from similar shifts in technology or market diversification to really maintain their evergreen status in what feels like an increasingly dynamic and, frankly, volatile global economy? Something to ponder as you continue building your own portfolio.